Hey everyone, hopefully you're having a good day. My name is Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. The reason it's commodities, and I don't just focus on commodities, is because that's where I think the value is. Commodities include precious metals. So let's dive in there. Let's take a look, see what people are sharing. If you want to follow me at Financial Finance, if you want to join our community, finding-value.com, you want to learn how to invest, that is where I would go. I wish I had a mentor. I wish I had myself as a mentor when I was younger. I don't know too many people that have the same kind of outlook as I do. And we've got the three pillars: ratios, technical analysis, and market conditions to figure out what is in cycle and what is doing well. So coming on down, Eric Neville, he says the sudden collapse in refining margins is being used to support the narrative of a sudden and sharp slowdown in U.S. oil demand. I got to ask two CEOs whom I respect, each with deep downstream experience, their thoughts. They believe the collapse in crack spreads is more attributable to the end of summer driving season and the addition of 5.5 million barrels per day of new refining capacity over the past 2 years, and not a sudden slowdown. Two, we are we are normalizing from the 2022-2023 spike in cracks attributable to a rise in diesel demand after Nord Stream 2 sabotage. In their view, and one has several U.S. refineries, demand remains healthy enough. That is what they have to say from the insiders and Eric Nuttall on crack spreads. Crack spreads is the spread that the refiner gets between gasoline price or diesel price and their input price of oil, whatever oil it is. So that's the spread that they make in refining. Some people use the gasoline price and the crack spread as a function of demand. But a lot of people don't take into account the supply side. They're saying it's more supply driven than it is demand driven. That's really what they're baking it down to. They're like, no, 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 no. Demand's fine. It's just we've got more supply, which is squeezing down the crack spreads, which is how much money the refiner makes on a barrel of oil. Finding value, that's me. Gold to oil ratio, very cheap oil. Momentum is with gold, with market conditions at the moment. So at the moment, what we have, and this is, I'm not stating that oil's bottoming. I'm not. That's not my purpose with this. My purpose with this is we know when something is cheap, and what is going to occur, in my opinion, is gold. They say gold leads. Gold leads, and that's exactly what it's doing. That's why the ratio is breaking to the upside. It leads and then it reprices all the commodities higher, is what it's going to do, in my opinion. So if we're at a ratio of 1 ounce of gold equals 37.3 barrels of oil, that is really, really cheap for oil. When we get to levels above 30, you're basically talking about levels that are unheard of cheap. So when you look at the line going across here, we had it one time in 2016 almost, and then the 2020 COVID shutdown. The shutdown's an anomaly, okay? That's the way that I look at it. And then you go all the way back, and it was not that cheap in the 2000s, the 1990s, and not even in the 1980s or even the 1970s if you were to look at charts all the way back there. We are cheaper. We are the second cheapest time in history for oil against gold. And gold is about to rip. Think about that for a second. If we get to 40 or 50 up here, when gold's really breaking out against oil, or maybe oil bottoms here potentially, what this would be is a shoulder, a head, and a shoulder. And we're at the right-hand shoulder that we could come back down in, and the neckline is here. That could be a potential possibility. Now, do I know that for a fact? I don't. And everyone on Twitter is going to tell me that we're going into a slowdown, we have a recession, and oil's going to $40 or $50. And that's the same thing that they told me when we were in COVID and just slightly after COVID. They said that oil is a horrible investment. It's never going to go over $30 or $40 again. And you know what I said? I said, I'm going to buy as much oil as I possibly can in the oil equities. Now, I'm not stating that this is the same setup, but the setup does rhyme. And I'm not afraid to buy stuff when people are telling me I'm stupid, because that's usually when I make the most amount of money. That is usually when I make the most amount of money. So I'm going to watch this. That's something I'm watching. For the silver bulls, looks good in my opinion. So what does this look like here? I just took a trend line going across this trend line here with 1, 2, 3, 4, 5. There's 5, 6 hits on this trend line. And then I projected it upward on top of this. I ran it all the way up, and this is where I think we're going. Maybe $300, maybe. We've broken through the resistance level here. We broke through this resistance level and ran. We broke through this resistance level and ran. And you know what? I want to make a comment here too. Increasing interest rate environment. Increasing interest rate environment. Barely on this one. Now we're in a full-fledged increasing interest rate environment where we've broken that 40-year downtrend line. This could be a big move, guys. You don't have too many opportunities in your life where you get these setups like this. For most people, they might have experienced one move. I experienced about half of this move here. I was too young in the beginning of it. I was in high school in 99, and in college. So I missed part of this move. I wasn't that engaged in investing. So you don't have too many of these big opportunities here. But you know what? I'm taking full advantage of this. Screw that. I am taking full advantage. Here's SILJ and divided by silver. It's a ratio. Looking for it to start outperforming silver here. We haven't even started this, guys. Like, this move is at the beginning stages. And we saw some ridiculous moves in silver yesterday. Ridiculous moves. So this is looking really good. We're coming from a very low area where silver juniors could really start to outperform silver itself. David Burrows says, on cue, commodities may be finding support at the long-term moving average, just as it curls higher. No surprise that it happens to coincide with the beginning of looser financial conditions and liquidity. So this is the commodity bear market bottom. That was in to be precise, but I bought it in 2020 for a lot of the companies because I saw this coming. I saw the bottom. It just looked absolutely insane. The equities, a lot of uranium stocks looked really good in 2020. And here we are. This is our first kind of breakout, and we've consolidated sideways. We're ready to go here. We're ready to go. I think commodities over the next 6 months, year, are going to do something. We'll find a bottom here, get moving higher. Here's the market sniper. Gold, new all-time high, and it hasn't really got started yet. XAU divided by Dow Jones. That's the XAU is gold. DJI is Dow Jones. And so it says, note low volatility spells into super surges right now and previously. So what we look for is a dead period. That's what I call it. And the dead period are these super low volatility. So you come on down, the momentum gets worked off in a dead period, and then you switch to higher lows and higher highs in a period that nobody sees. That's your smart money accumulation zone. Everyone else wakes up when it starts to move. This is your smart money accumulation zone. And then it moves, and then your smart money accumulation zone, your dead period. That's where people like myself are hyper-focused in trying to buy. Now, here's the downside. Most retail investors, they try to buy it in these zones, and since it doesn't move immediately, they get bored. So then they sell out and go and chase price somewhere else. All of the gains, if you can buy the bottoms in here, all of the gains, if you can sell it up at the top, are just massive. That is how you make all the money in the markets. You have to buy when it's cheap and sell when it's expensive. And you have to be patient for these to make their turns. Oh, but it's a lost opportunity. Shut up with the lost opportunity stuff, guys. Oh, you didn't make 20% every single year, but over this entire move, you made a 60, 70, 100% compounded return over the time frame you held it. Don't give me that crap, guys. No, no, no. Nick Lawson says enriched uranium is up 325% since war versus the spot, which is only up 61%. Downstream prices show where U308 is going. Focus on the refined uranium. It's going up. SWU is going up. UF6 or whatever. These will follow. Stop being so bearish, everyone. Gosh. Tim Hack says gold pushing through into uncharted territory, new all-time high. Over 2,500 bucks. Here we go. Let it rip. Peter Schiff says with gold at 25.50 and oil at 67, one can buy 38 barrels of oil with just 1 ounce of gold. Outside of the pandemic oil crash, oil has never been this cheap. That's good news for gold mining stocks, but bad news for Americans, as it means much higher oil prices are coming, and I completely agree with that. We are off the page cheap for oil, and it's probably due to the elections. Guys, the opportunities here keep slapping me right in the face. They're slapping you in the face. Take advantage of it. Don't be a price chaser. Get in there when the prices are cheap and do your evaluation to figure out what companies are good. Then you can buy them when they're cheap, sell them when they're expensive. That's how you make money. Stephanie Pomboy says, holy budget deficit, Batman. August deficit comes in at $90 billion ahead of estimate. Looks like we won't get the details until 2 p.m., but this is ugly. Kiwi Infinity coming soon. No wonder gold is flying. Exactly. Inflatione. Fiscal spending. Fiscal is carrying us. Now, are we going to get this big pullback and recession that these hyper doomers are coming? I don't know if we are in nominal terms. Nominal terms. Think about nominal, not, real versus nominal, two different things. Eric Nettle, energy ignorance abounds. A man running to be the next vice president of the United States on CNBC this morning said that U.S. oil production should be 3 million and natural gas production should be 2 to 3 times higher. Days ago, oil flirted with break-even pricing, drill baby drill to increase production, lower energy costs, and bankrupt the oil companies. The market is vastly underestimating supply destruction in 2025 at current levels as we approach budget season. U.S. shale has been flat for 8 months at 77 WTI and projected by Rystad to be flat for another 9 months. Presuming higher than current pricing, U.S. shale declines alone could offset demand destruction equivalent to a 1.5% global GDP drop. So that's where we're at. We are at demand destruction pricing. You can't, no matter what these people say, the vice president can say, oh, go drill. It's like, we won't. We need prices at $90 to $100. We're not drilling at 77 or 72 or 68. Sorry. So break-even prices for new wells. In the top 2 areas in which your firm is active, what WTI oil price does the firm need to profitably drill a new well? Permian, other, $70. There's your break-even for some of the companies. And obviously there's other companies here, 59, 62, 64, 65. We are at the break-even point for where all the growth came from in the world for the past 10 years. When do you buy a commodity? When it hits and goes below the break-even point. We are there. We are there. Coming back, we've got dividends are the holy grail of passive income because it's money you earn for doing zero work. Rental properties require upkeep. Selling books requires promotion. YouTube requires creation. Running a business requires work. Dividends require no work at all. Buy, hold, get paid. You guys want to learn about how to create a dividend portfolio of commodity equities? Perfect. Sign up to the website. Use the Mayday coupon code. at finding-value.com, and we can put together a dividend portfolio, a sample portfolio, not for you. I can't do it for you. You're going to have to do your own, but we can do it together and look at the companies and come up with a portfolio of dividend payers. I have a dividend portfolio too, where we can get paid and do nothing. Now, here's the cool thing about this. Commodity companies, their earnings comes from commodities. It's not from a set price beforehand. Uh, that like regular companies can't really increase the pricing of what they sell too easily. What I am saying is that when the commodity prices go up, like we're seeing in gold, for example, that's going to happen in oil. The dividends from those commodity companies will explode. There are companies that pay a base dividend and then they pay special dividends. There's a lot of Canadian companies like that. Your dividends can range from a couple percent all the way up on your original money. I am willing to bet by the end of this bull market, we will be getting dividends in size greater than the original amounts that we put into the companies at this time here. Which means if I put in $100,000 today, I will get, by the end of the bull market, probably 100 grand in dividends paid out to me, probably on a yearly basis. Like that's how much they will grow. And that's coming from the expansion of the commodity price. So if we're at break evens here for Permian Basin and some of these higher cost producers, they're not going to pay large dividends. So if they pay a 3% dividend today, that's off very little margins. If we go to $150, $200, $250 oil, which I think is a high probability due to the denominator, the dollar going down, that is when their dividends are going to explode. And I don't think people understand that dynamic. They do not understand that. So I'm not going to get paid 3% dividend yields on the money I put in, today in the future. In the future, I could be getting 50, 60, 70, 80, 100% dividend on the money that I put in today, paid out a few years out. So if I put 100 grand in, I might be getting 100 grand in dividends a few years out, depending on where the oil price goes. Now, some of these companies that I research are also growing production rapidly. So I can get a dividend and they're growing production rapidly. And when that production goes into a higher cost environment, their earnings are going to explode and their free cash flow will dramatically increase, which then means that I will get paid more dividends. Because if they're already paying dividends, they are usually shareholder friendly and they will usually return money back to shareholders either through share buybacks and or dividends. So it's such a great opportunity here to be buying towards the bottom of a bull market in commodities. BTC crypto, recall I had pointed out with this graph that it had lost its weekly 30 MA and that it's now watching its biweekly 30 MA. Well, I added a support line which is under the biweekly 30 MA to be aware of. So this is Weinstein stage 3. So stage 2, stage 3, stage 4 decline. Is this what Bitcoin could go through? It's possible because when you go into a commodity bull market, you go into an inflationary time frame. Sometimes these tech stocks do not like an increasing interest rate environment, but this could get kicked off under a slowdown where rates and the NASDAQ go down together. NASDAQ is highly correlated with Bitcoin. So they could fall like this under a declining interest rate environment. Then we have to raise rates later on because I think it's going to cause an inflation problem. And that's when precious metals just go ballistic. And that's what they're doing. Freight futures AM update. Dry bulk is down 2% for Capesize and Panamax. VLCC was up 2%. Suezmax is flat. Here's a really good quote. My biggest investment mistakes were not buying enough of the ones that were really good. Obviously, looking backwards, 2020 vision. How do we get good enough to know when to overweight and put a good portfolio position size on the ones that are going to outperform in the future? That is an art to some degree. And we can use technical analysis. We can use ratios. We can use market conditions to find the best companies. And I think I have a pretty good strategy and method for finding the best companies. And it's a little bit of fundamental and technical analysis married together with a bunch of work and listening to some of these calls, is what I'll say. Louis Vincent Gobb says, there's three possible explanations for the painful meltdown in commodities. Global growth is slowing hard. China has hit a brick wall. Someone, a trading house, a large hedge fund, an investment bank, has funded large commodity trades with JPY borrowing and is now being tapped on the shoulder. The recent strong daily correlation between the JPY and the oil price leads me to believe that it is the latter. Could be the case, but guess what? I don't really care. It's all short term. And what I really think about is if we are low, which we are, because I can, with certainty, say that we are cheap in relationship to gold, oil, and that is an opportunity. It's an opportunity. So I want to take my emotions and my opinion out of it, and I want to look at things from a logical perspective and something that is a measurement compared to history. That's how I do it. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we've got Mayday coupon code that's still active. But that's all I've got. We'll catch you next time. Oh, and the question and answer session is tomorrow, 7 a.m. Mountain Time, just as a reminder. All right, guys. See ya.